Welcome to this webinar. I'm Doriana Cucinelli and I'm a research fellow at EMEA Association, the Euro-Mediterranean Economist Association, and I'm also assistant professor in banking and finance at the University of Milano Bicocca. Today I presented the policy paper Suitable Recovery Post-COVID-19, a twin proposal to preserve bank resilience and funding the European economy. This policy paper is written with Professor Ayadi. She is the founder and president of EMEA Association. Consequently to the COVID-19 pandemic, the European Commission issues several measures to protect health, economy and employment. In this slide, you can see the measures issued by the European Central Bank, the European Banking Authority, and national banking authorities and government to support the banking system. The aim of all these measures is to ensure that banks could continue to fund the real economy to face this crisis. During the past decade, a lot has been done to increase the soundness and the resilience of the European banking system. The recapitalization process of the last decade made the banking system more resilient and robust. The Tier 1 ratio increased, passing from 10.2% of 2009 up to 16% at the end of 2019. The non-performing loan ratio decreases. A constant reduction in the non-performing loan ratio depended on two main reasons: the cleaning up of the bank balance sheet through the sale of a large amount of non-performing loans and the economic recovery of recent years, while profitability and cost efficiency decreased during this period. Although the European banking system seems healthier and more resilient to the macroeconomic shocks as compared to the situation prior to the financial crisis, banking system characteristics differ across countries, and therefore the COVID-19 crisis may impact them differently. In 2019, countries such as Italy, Portugal, Spain, and Austria show CET1 ratio below the euro area average, whereas in the other countries, CET1 ratios are well above the euro area average, such as in the case of Ireland, Belgium, and Eastern European countries. Looking at the non-performing loan ratio, there are countries still showing very high level of non-performing loans, such as in the case of Cyprus, Greece, and Spain, while other countries show very low level of NPL, such as in the case of Norway, Sweden, and Luxembourg. Across European countries, the average value of return on equity largely differs. Some countries, such as Greece, Germany, and Portugal, show very low return on equity ratio, close to zero, while other countries, such as Norway, Sweden, Eastern countries, and Slovenia, have profitability above European average, with Slovenia with a return on equity ratio higher than 10%. The actions taken by authorities and governments are necessary conditions for an economic rebound and are mainly aimed at fighting short-term liquidity problems in order to contain bankruptcies. However, the increase of banking loans rises an individuals and firms' leverage through greater debt, and therefore their default risk, and consequently also the bank risk exposure. Consequently, also the bank's non-performing loan may increase. In light of this possible situation, additional European measures could be crucial to support the banking system and the real economy. In this policy paper, we propose two possible solutions to support the real economy and the banking system on the long term. The first, on the firm side, the capital injection into firm equity to support businesses in growth and investment. And the second, on the bank side, the realization of a Eurozone Bad Bank to manage the increase of NPLs in bank credit portfolio. The European Commission has already permitted member states to intervene in providing equity for firms through state aid, which is usually not allowed to ensure there is fair competition amongst firms and countries. However, European Union countries which are fiscally stressed, such as Italy and other countries, will hardly be able to intervene to help their businesses. On the contrary, recapitalization with government funding will be consistent and robust in those countries that show a strong fiscal situation, such as Germany and Austria. In light of this scenario, one possible path would be the creation of a pan-European fund supported by the European Union. The fund should have restrictive rules in order to direct funds only to worthy companies. The economic rationale of the equity fund is that it would allow European companies to invest and compete based on profitability and independently of the fiscal capacity of their countries. On the other hand, the idea of a European Bad Bank comes back into focus. The realization of a Eurozone Bad Bank may be able to remove market failures, thereby increasing transparency and diversifying NPL supply. Someone could object that the presence of a bad bank could lead banks to engage in improper behavior, such as moral hazard behavior. The answer is the introduction of a clawback clause. However, without any warrant, the risk of selling price lower than economic value remains on banks. Therefore, the clawback in form of warrants to national government could be another possible solution. Also in this case, as in the case of equity fund for firms, the problems are related to the fiscal condition of each European Union countries emerge. A pan-European fund that intervenes when the clawback clause is activated could be the solution, at least for the new stock of non-performing loans that will emerge following this economic crisis due to the COVID-19 pandemic. In conclusion, the pandemic could provide the occasion for a new starting point for the Europe built on risk burden sharing, to continue building the single market at the risk of fragmentation. The European Equity Fund and the European Bad Bank, funded with resources from all European Union countries, could help to create a common perception of shared responsibility and solidarity across Europe. Over the long term, this measure would strengthen euro stability in conjunction with the financial stability of the European Union. Both firm risk and bank risk would be directly shared across member states, strengthening cohesion across the European countries. Thank you.